of American business depends on how much it delivers in cash to its owners over between now and Judgment Day, and I don't think it changes in 10% in a 2-month period if you're looking at it as a business. Now you've got anything can happen in markets. I mean, anything can happen in markets, and that's why I say don't ever borrow money against securities. That markets don't have to open to borrow it.
Ever wondered how Warren Buffett, the sage of Omaha, the investing wizard himself, made his billions? Well, today we're going to delve into the intricacies of Buffett's investment strategy. So buckle up and get ready to embark on a financial journey of a lifetime, where we'll decode the art of patience, persistence, and intelligent investing.
You can have extraordinary events. So I think to some extent you can get some of the instruments that people don't understand very well that have a lot of firepower in them. The idea of people taking a position, and they're gambling, they're not investing. Nobody's investing when they buy, some supercharged index on, on how the VIX does or something like that. They don't need it in their life. It's an unnecessary instrument. Now, they will create instruments that the public will buy, and you can just count on that. Wall Street's been doing that since they met under the Buttonwood tree in 1792 or whatever it was on the exchange. So if you're investing, if I'm going to buy a half interest in a McDonald's stand and you're going to run it, or a McDonald's franchise and you're going to run it, I look to the business to determine whether I made a good investment. And I'm concerned about whether we have new competition, how we do over the years. But it's the business I look at. When you're just looking at the price of something, you're not investing. I mean, if you buy something, Bitcoin, for example, or some cryptocurrency, you're not looking to the asset itself to produce anything. If you buy an apartment house, you're looking at how the apartment house does. If you buy a farm, you're looking at the farm does. If you buy a whole business, you're looking at how the business does. If you buy a part of a business, why shouldn't you look at how the business is going to do? But people get charmed by lots of action and the fact that things are liquid and all of that. And it does have repercussions back into the market when you get something like an ETN arrangement on the supercharged on the VIX. I mean, where you can lose 90% of your money in one day. I mean, that really doesn't belong with the word investment. I mean, it's a gambling. You can buy small pieces of businesses for less than you can buy whole pieces of business. So you get a bargain as an investor compared to what I can get in terms of buying the whole business. And people, if they just think of stocks as pieces of business, they'd be so much better off than thinking of those little things that move around in price. And I think with Berkshire, we have an unusual number of people as shareholders who just look at Berkshire as a business. They look at it as a savings account. They put some money in 20 or 30 or 40 years ago. We retain it and reinvest for them, but we're their savings account. And that's the way I look at my own stock. That's the way Charlie looks at the stock. If you buy a 30-year government bond, it has a whole bunch of coupons attached. In the old days, it does now, it's electronic. But it has a whole bunch of coupons. The coupon says 3% or whatever it may say. And that's what you're going to get between now and 30 years from now, and then they're going to give you the money back. What is a stock? A stock is the same sort of thing. It has a bunch of coupons. It's just they haven't printed the numbers on them yet. And it's your job as an investor to print those numbers on. If those numbers say 10%, and most American businesses earn over 10% on tangible equity, if they say 10%, that bond is worth a hell of a lot more money than a bond that says 3% on it. But if that government bond goes to 10%, it changes the value of this equity bond that, in effect, you're buying. You are buying, when you buy an interest in General Motors or Berkshire Hathaway or anything, you are buying something that over time is going to return cash to you. Maybe a long time in terms of Berkshire, but it'll be bigger numbers. And those are the coupons, and it's up to you, your job as an investor, to decide what you think those coupons will be, because that's what you're buying, and you're buying the discounted value. And the higher the yardstick goes, and the yardstick is government bonds, less attractive these other bonds look. And that's just fundamental economics. So in 1982 or 3, when the long government bond got to 15%, a company that was earning 15% on equity was worth no more than book value under those circumstances, because you could buy a 30-year strip of bonds and guarantee yourself for 15% a year. And a business that earned 12% was a subpar business then. But a business that earns 12% when the government bond is 3% is one hell of a business. 2.4 to 2.9 is nothing if you're comparing it with businesses that earn 12% on equity and reinvest. And the S&P, you can just look at the figures for decades, has earned on tangible equity. It's earned a lot more than that, and it translates into higher prices, and it should. It is gravity. I mean, if you told me interest rates were going to be 15% next year on bonds, there's a lot of equities I wouldn't want to own. Some people should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things because your stock goes down, if you buy your house at $20,000 and somebody comes along next day and says, I'll pay you 15, you don't sell it because the quote's 15. You look at the house or whatever it may be. Some people are not actually emotionally or psychologically fit to own stocks, but I think more of them would be if you get educated on what you're really buying, which is part of a business. And the longer you hold stocks, the less risky they become, whereas the longer the maturity of a bond, the more risky it becomes. People would rather gamble. I mean, the idea that you can double your money in 6 months, that's just going to, it's why people go to the races, why they go to Vegas, whatever it may be. They even know the odds are against them, and they still do it. I mean, it's a strong instinct to want to get rich fast, and I don't know how to do it.
It depends on their personal situation. If you're working in something where you're living off your paycheck from week to week, you want to have a little cash around, and you certainly don't want to have a credit card that's maxed out or anything like that. But if your house is paid off, if you don't have big living expenses, you got a portfolio of decent diversified businesses, don't really need any cash. Yeah, I've got responsibility. We've got insurance claims. We could have hurricanes that would happen. All kinds of things where we might have to pay out billions of dollars. And I've got over 1 million people that own shares that are counting on me to run the place so we get through periods like that. But if I were retired, I had say $1 million portfolio of stocks that was paying me $30,000 a year in dividends or something of the sort, and my children had grown, the house was paid off and everything. I wouldn't worry too much about having a lot of cash around. Well, if you have to closely follow a company, you shouldn't own it. If you buy a business, if you buy a farm, you go up and look, every couple of weeks to see how far the corn is up, and you worry too much about whether somebody says this is going to be a year of low prices because exports are being affected or anything like that. You buy a farm and you hold it for. I've got one farm that I bought in the 1980s, and my son runs it, but I've been there once, I mean, it doesn't grow faster if I go and stare at it. I can't cheer for it, more effort, or something like that. And I know there's going to be some years when prices are going to be good and some when prices aren't going to be good. I know there's years when yields will be better than others, but about the farm. And it just doesn't, I don't care about economic predictions on it or anything of the sort. I do care that over the years it's well tended to in terms of rotating crops, and I hope yields get better, which they generally have. In fact, that farm 100 years ago would have probably produced 30 bushels, maybe 35 bushels of corn per acre. Now in a good year, it'd be 200. I mean, we've really made progress in this country. That's one reason commodity prices go back a couple hundred years. They've moved so little, is because we've just gotten better and better at whether it's cotton or whether it's corn or soybeans or all kinds of things. And you and I have benefited from that. Well, it's a long-term investment, and if you own the best auto dealership in town, the best brand, and had a good running, you wouldn't drop by every day and say, how many people have come in today, or I think interest rates are going up a little, maybe it'll slow down our sales or anything. No, you buy it knowing there's 365 days a year, and you're going to own it for 20 years, so that's 7,300 days, and things are going to be different from day to day and year to year. You shouldn't buy it if the day-to-day stuff is important.
I was interested in watching stocks, and I thought stocks were things that went up and down, and I charted them. I read books on technical analysis. I read Edwards and McGee. I think that was the classic then. Hundreds and hundreds of pages. And I read that whole thing over and over again. And I read Garfield, Drew, I read everything. And I thought, the first 8 years, I thought the important thing was to predict what a stock would do and predict the stock market. And then I read Ben Graham, when I was 19 or 20. And I realized that I was doing it exactly the wrong way. But it didn't hurt that I had that background and everything. I rejiggered my mind and when I read the book, The Intelligent Investor. And from that point, I never bought another stock. I bought businesses that happened to be publicly traded, but I became an owner of a business. I did not care whether a stock went up or down the next day or the next week or the next month or the next year, and I didn't have any idea what it would do. I didn't know what the stock market would do, but I knew businesses. You don't need to be a genius in what I do. That's the good thing about it. If I went into physics or a whole lot of other subjects, I'd be an also-ran. But I am in a game that you don't need. You probably need 120 points of IQ, but 170 doesn't do any better than 120. It may do worse, probably do worse, but you don't really need brains. You need the right orientation. 90% of the people, I'm pulling the figure out of the air, but 90% of the people that buy stocks don't think of them the right way. They think about something that they hope goes up next week. And they think about the market as something they hope goes up. And if it's down, they feel worse. I feel better. And I hope it goes down when I buy it because I'll buy more. When I want to do something, I always want to do it big. I have never had less than 80% of my money in American business. You can call them stocks, but I see them as American business. I've owned a piece of American business for at least 80%. I would have to honestly say that what makes me happiest is what I'm doing. I know I'll win over time. That doesn't mean I'll beat everybody else or anything like that. But I'm in a game that's very, very, very easy if you have the right lessons in your mind about what you're buying. I'm not buying stocks. I'm buying pieces of overwhelmingly American business. And I'm happy when that's when I'm doing it. I'm happy when stocks are going down. I'm happier when stocks are going down because I can buy more of them with the same amount of money. I'd be happy if I was a farmer. I'd want farmland to go down so I could buy more acreage. If I was, it just makes sense. And I'll tell you the second thing I really like. I like being trusted by people. And, I would rather do what I do with partners than do it sitting in a room myself, even though I might make more money that way. They just say, look, I've saved money, I don't know what to do with it.
As we say goodbye today, let's keep Buffett's wisdom in our minds and his success in our sights. We hope his story has ignited a spark within you, inspiring you to approach investing with the same curiosity, patience, and persistence. If Warren Buffett, the grandpa of Wall Street, can do it, then why not us? Until next time, keep learning, keep investing, and remember, patience and persistence are the keys to the treasure chest of wealth.
And I trust you. And they give it to me. And they don't, most of them give it to me, certainly in the original days, but even now to an unusual degree. I'm sort of their savings machine. And they don't do it with the idea they're going to retire when they're 65 and then build great castles or anything like that.
I think it was about 1992 that shortly after I met Bill Gates, I was out at with his parents, and they had some other guests. And Bill's dad asked each of us, and there were probably 20 or so, to write down on a piece of paper one word that would best describe what had helped us the most. And Bill and I, without any collaboration at all, each wrote the word focus. And I would say my partner Charlie Munger is an extreme example of focus. That's why Tiger Woods hit 10,000 putts too, or Roger Federer's. but spending 3 or 4 hours a day hitting a golf ball, or some pianist has been spending 5 hours a day practicing. Focus is just bearing down on something that in my case, and I think probably the case of most people that are reasonably good at what they do, that they enjoy. You wouldn't be able to do it if it was work. So it's a natural. It is not. I say to myself, I'm going to focus on this or do anything of the sort. It's just a natural behavior, and it's been that way ever since I was a kid.